Hi, my name is Jason, and I would like to invite you to just give me 15, 20 minutes tops for me to walk you through how Exertus is introducing this be your own bank concept for you to be able to take advantage of some of the strategies and the options that are out there for you to live your best life possible. What we're going to show you in the next few minutes here, we're literally going to be showing you some of the strategies and some of the things that the wealthy, like the ultra wealthy, are doing to create wealth, not just in our lifetime, but what we like to call generational wealth. We want to show you these things that are being done by people all across our country, all across our globe, that are taking our lives to the very next level, that are taking things to the next level for our families. Because what we have is we've got this ability. We want to show you how you can use some of these wealth accumulation strategies, because it's not just average people, normal people like you and I that are doing this. We've got people like these three men that you see here on the screen. I'm going to give you a quick rundown of each of these. And what each of them, if you don't know who some of these people are, I encourage you to look them up. Most people know this guy on the far side of the screen, Mr. Walt Disney. It's not a big hidden secret, but not a lot of people know about it. The more I talk about it, it's been kind of surprising. Did you know that the concept of Disneyland would not have existed if it were not for life insurance? When Disney first had the idea and that concept of what he wanted to create, that happiest place on earth, when he had that concept, nobody bought into it. He went to family, he went to friends, he even went to a couple of banks, pitched the idea of what he wanted to do, and they all said no. But what Disney had is he had an insurance policy, a whole life policy that had some cash value built in it. And he was able to pull out a loan from his life insurance policy and fund Disneyland. And then, of course, the rest, as they say, is history. And he paid his policy back in full, and everything is for the history books. And we've seen what has happened there. And Ray Kroc, if you don't know his name, I highly suggest jump on Google, check this guy out. He was actually the very first person to own a McDonald's franchise. He took this concept, he knew, like this roadside burger joint, he knew that there was something special there. So what he wanted to do was to be able to, take this and go to like a whole nother level. Like he understood the concept of like interest compound and how to really get things moving in a way that had never been done before. Now, most of you know this guy on the other side of the screen, John D. Rockefeller. If you don't know of him personally, you probably recognize the name. The Rockefeller family is easily one of the wealthiest families in our time. Now, their time came actually, like where they grew their wealth the most, actually came from where most people lost their wealth. It started during the Great Depression. So let me ask you this. So how does one make their wealth in a time when everybody else is losing? How does one gain such wealth when everybody else is going broke and they're losing their jobs and they're having to give up their homes and their families are being torn apart? So how does one do that? Well, it's actually pretty simple. So when we start asking the question of, well, how did the Rockefellers survive the Great Depression? Well, it's pretty easy. Where everybody else had their investments locked up in the stock market. So when the Great Depression hit, the stock market crashed, and people all across the country, all across the world, they felt the impacts of that. But what the Rockefellers did, they didn't have their their investments tied up in the stock market. They actually had their investments and their funds, they had it invested into life insurance. They had it invested in, there's a couple of different types of policies. We're going to touch on them briefly here today. There's a couple of different ways that you can invest in it that are not tied to the stock market. So you're gaining a guaranteed interest rate year over year, and you're always gaining. It's guaranteed. So this is how the wealthiest family of our time, one of the wealthiest, this is how they managed to go from, an era, so the Great Depression era, where everybody else is losing, and they skyrocketed them into the generational wealth that they have now, and they've gone on to do many other things as a result of that. This isn't a history lesson on this family, but what's interesting is they use the same concepts that we're going to show you right now on how to create generational wealth. Now, what is this? You see here the logo at the bottom of your screen, BYOB by Exertus. Let me introduce to you the BYOB concept. Now, before I get to that, let me ask you this question. Are you sure that you're going to have a great retirement, or do you have some doubts? Now, in the United States, we have this issue. It's the debt issue. Over 44 million Americans hold over $1.5 trillion in student loan debt, $1 trillion in credit card debt. 42 million Americans have a medical debt of some kind. Americans in general, in total, they hold 8.8 trillion in mortgage debt, 1.22 trillion in auto loan debt. American households, we're not talking just across the globe, we're talking just the United States. American households combined hold $14 trillion in debt. Now, this is not for me to shame you or to shame anybody. I have debt. We all have debt of some kind. Now, it's what are you doing about that? One of my favorite sayings is, it's okay to not be okay, but it's not okay to stay that way. And I think that applies to this debt issue. If you made decisions at one point in your life and you took on loans, or you took on this, or you had to get credit cards to survive, look, I'm not here to cast judgment. I'm not here to shame you. If anybody does that, shame on them. Everybody has this issue at one point or another in their life. So it's not a matter of do you have it, but what are you doing about it? Now, what if I could show you how to get out of debt in 12 years or less, including your mortgage, without spending any extra money than you currently are right now? If I could show you that, would that be something that you would be interested in? Now, on the right side of the screen, you'll see this guy, easily one of the most recognizable people when it comes to the finance industry, Dave Ramsey. Dave Ramsey, he's not the first one to come out with this concept, but in the last probably 10, 15, 20 years, he has really taken it to the forefront and really mainstreamed this idea of what's called debt snowballing. So in short, let's just say you have 4 different lines of credit. So let's say a credit card, 2 cars, and a house. So the debt snowball approach is basically where you put them in order of, your lowest balance first, and then you work up. So what happens is you pay off debt number 1, and then, you take all of the 4 debts down to minimum payment, and then you pay any extra that you have available on debt number 1. And then once debt number 1 is completely at a 0 balance, then you take that minimum payment, add it to whatever you were paying, and then you apply all of it to debt number 2, and then you start paying that off. And then once debt number 2 is gone, you take all of those funds, you apply it to debt number 3, and so on and so forth until eventually you have no more debt. It's called debt snowballing, to where you're just taking those payments and you're rolling one into the next, and you're attacking that debt. To use the Dave Ramsey phrase, you're attacking the debt. Now, R. Nelson Nash, if you don't know this guy, you should definitely get to know him. He was the guy that he introduced this concept, becoming your own banker, using the infinite banking concept. And really what that is, it's showing those life insurance policies, showing you how to utilize those. Now, I understand not everybody understands life insurance, nor do they really want to learn it. And I get that. Insurance is not sexy. There's nothing real fun and exciting about talking about life insurance. But what we have done with BYOB by Exertus, we are matching this infinite banking concept by Nash and matching it with the debt snowballing effect that Ramsey has made so popular in our culture. Now, what we are doing is we are matching those two together. We are putting them two together so that you can utilize the infinite banking concept, not only to create wealth, but we're also going to use this first and foremost to attack the debt. And we're going to use that to attack this debt snowballing. So let me ask you this. How do banks make money? Well, it's pretty simple. First, you put money in the bank. Then the money that you put in there, they're going to give you, probably around 0.01. I've seen somewhere you might get like a 1% interest on it. And then the bank leverages your funds and then it's going to borrow it out to your neighbor. And then they're going to charge them anywhere from 8% up to 29%, depending on if it's a personal loan, auto loan, home loan, credit card, whatever it is. So while you're gaining a very minimal amount of interest, the bank is actually taking your money, leveraging it to create debt for someone else and charging them a premium interest rate. So does that seem right to you? Well, whether it does or not, that's how banks make their money. Now, with a traditional banking concept, let's think about this. Let's just say you have $100,000. At a 0.01%, that's $10. You made $10 interest on $100,000. After taxes, 7. Now, with the BYOB concept, that same $100,000 at a 4% interest rate guaranteed, you make $4,000. And on top of that, we can show you how that it can be tax-free. Now, like I asked a while ago, is that something that you might be interested in? So let me show you how we do this. Now, this is what's called a non-direct loan. This is a loan provision that you won't find in any other financial vehicle. The cash value on the policy would be the same as if you would have not taken out a loan. This is what is so crazy. So let's say you have $50,000 of cash value available, and mama needs a new car. So you take, let's just say you take 30 of that and you go buy her a new car. So while you're borrowing from your own money, hear that, you're not paying interest, you're not paying any fees, you're not doing any of that. You are just very strictly and simply borrowing from yourself. So if I have $50,000 in cash value, I need to buy my wife a new vehicle. Hers went, belly up, time to get her a new one. Let's say I take 30,000 of that policy out to go buy her one. Now, what's so amazing about the non-direct loan is your interest rate still gains on the 50,000. It does not penalize you for taking that loan amount out. So you still gain interest on the full amount, even though you've pulled a loan out for a car or for whatever it is, daughter's wedding, whatever it is that has come up, you can now pull out that loan and you will still gain interest on the full amount. That's what makes this so awesome. Now, on the other side of that, how do mortgage loans work? Most of you on this that are watching this probably have this piece figured out. And it goes the same with mortgage or cars or really anything else. Your early payment. So let's just say on a mortgage loan, if you have a standard 30-year mortgage, for the first several years, the most part of your monthly payment is actually going to interest, not to the principal balance. So, and that's the same that works for homes, cars, any major purchase, because the bank's going to make sure they get their money up front. Now, average interest rates. So whether it be, you're going and you're getting for a house, for a car, for a credit card, I don't know where you're at. These are national averages. The average interest rate for a new car right now, 6%. I believe this actually just went down. The national average for a mortgage loan, 6.5. Credit cards at 12. Student loans at 6. HELOC, a home equity line of credit at 7.3, and a personal line of credit at 5.7. Now, what is so interesting is this is just how people just assume that it is. This is how it's supposed to be. This is how it has to be. But let me ask you, what if there was a better way? Because honestly, there is. Let me show you. The BYOB method. Okay, so we got the money comes out. We're actually going to, so out of your paycheck, we're going to put it into this BYOB. So generate high cash value, use it as collateral, and you can actually borrow up to 95% of it. So just as we went through before, we're going to pay the first debt, and then we're going to debt snowball all the way through your list. Doesn't matter how much you have, we can find a way that we can do this without making you have to spend any extra money a month than what you currently are. Now, if you have extra you want to pay into it, great. But I don't know about you, but if I can get out of debt and not have to spend anything more than what I'm currently spending, that just makes sense to me. A few benefits of this. You can use it like your traditional bank. It's like a savings account. You can pull from it as you need to, you put back into it. You are building your private line of credit. So let's just say, we roll the clock for, 8 to 10 years. You're out of debt. Now you need to pay for a wedding. You need to pay for, college tuition expenses or whatever it is. You are building your own private line of credit. So it's your money. It's cash value that is there. So you can get it when you want it and how you want it. There is no oversight. There's nobody managing it for you saying, oh, well, you can't have it for that, or you can't do it for this, or there is no stipulations on what you can and cannot use that money for, because it's your money. You can finance future purchases. So if you need a vehicle, or kids are grown and it's time to downsize your house and you're selling one and you want to be able to use this, you can pay cash for your retirement home. You can buy that boat that you've always wanted. You can go buy those toys, whatever it is. You can finance those future purchases. Now, this, as we covered before, it does qualify for the non-direct loan recognition, which, just as a refresher, all that means when you pull out a loan amount, you're still gaining interest on the full amount, not the difference. Now, it can be an investment strategy. We have people that talk to us all the time. Well, Jason, what if I don't have debt? Awesome. I applaud you. Good for you. But we can still use the same strategy as a savings account, as an investment vehicle, because we can take those same funds, put it into here, gain at a guaranteed interest rate that's not tied to a stock market. And now you're gaining that wealth. Now, you can access it without penalty. There are no fees, there's no penalties, there's nothing like that to withdraw your money. And of course, who doesn't love a tax-free strategy? So if you can actually pull from your funds without having to pay taxes on it, guys, that just makes sense. And the other thing that is actually not on here, but what is built into this is actually a death benefit. So, we don't like to talk about what happens, when that time comes and, we pass away, but we have a death benefit to take care of our final expenses. Let's say something happens and you need, a long-term care facility. You don't want to be a burden to your family. They can use this policy to pay for those medical expenses while you're still alive. Those are called living benefits, if you don't know that term. That's what that can be used for. It's amazing what this policy can do. Let me just give you a quick case study and we'll be done here. Let me talk to you about, this is a family. We've we've omitted any of the personal information just for privacy reasons, as you can imagine. But let me talk to you about Manny and Janet, 45 and 40. Like everybody else, they want to retire at age 65. They have a newborn, a 4-year-old, and an 8-year-old. They have 0 college savings. Right now, their monthly income is at about $5,000. Manny's was. Janet's is about $2,500. They have a desired retirement monthly income of about $5,000. Now, their goals, they want to increase their retirement income, obviously reduce debt, get spending under control, and start some college planning for the kids and increase their savings. So here's kind of their current debt summary. This is just as it is before we came in and did anything. Now, I know there's a lot of information on here. Don't really get bogged down with that. But what I want to show you, this section right here on the debt. Okay, so they have a personal line of credit, a car, Old Navy credit card, Discover, business credit card, a home equity, and then their mortgage itself. Just to the left of this, you'll see total payments. Here's the remaining. So here's how many payments they have left. So personal line of credit, they got just under 2 years, and then it kind of goes down from there. So we have the current balances, monthly payments, all this. So what I wanted to show you, this is where most people don't really realize. If you just look at the balance of what they have, they got $429,000 in debt, but 34, 38 in a monthly payment. But what most people fail to, think about is, well, what happens to all of that interest? Well, when we start accumulating this interest rate here, interest expenses. So 429,000 plus the 241,000 in interest means your actual debt is $670,837. Just on their payment plan, it was going to take them 25 years to get out of debt. Does this look familiar to anybody? But let me show you what we were able to do with this. Okay. Okay. This is with the BYOB. All right, let's show here. Okay, so same debts, personal line of credit, Old Navy credit card, Discover, car, credit, business credit card, home equity, personal residence, same 429,000, but with the debt snowballing approach and tying it with our BYOB. So make sure you pay attention to this. Let me go back one slide. Yeah. There we go. Total payments, 302. So basically 303 months. So equivalent of 25 years. Look at this, 13 years, 161 months. And that's including the personal residence. Now, what most people, what everybody wants to look at, by doing this, we're able to eliminate so much interest. Now, there's a couple of things I want to focus on here. As you look at this, now, what we have, All right, so you've got the balance, 529,000, monthly payments. There's your payoff. Over here, roll up deposit. This is what I want to really focus on this screen. Yeah, it's great. We took it from, 300 something months to 161. We cut that in half. That's awesome. But look at this. Roll up deposit. What does that mean? This is the monthly payment that you are paying each month. So look here, first one, $200. See that? 200. So we're going to roll that 200 up to the 76. So now we have 276. So we're going to take that 276, we're going to apply it to this 132. So once that's paid off, guess what? 408. So this is your debt snowball. This is how you see this accumulate. So by the time it's all said and done, so let's just say, okay, these other ones, yeah, that's great. Let's get these smaller ones knocked out and small. I say that kind of tongue in cheek, 94,000, that's not small. 27,000, those are not small. But let's say we'll eliminate everything but the house. We have freed up not only all of this debt, but we've also freed up over $2,000 in monthly cash flow. Now, as it sits right now, we're taking that and we're applying it to the house. So we're attacking that mortgage debt. So by the time it's all said and done, we have $3,438 in monthly cash that is now going to be usable for your family. Now, just a kind of a side-by-side comparison, we took 11.8 years off. As it was 25.2 years, we took that down to 13.4. Look at this, we saved them $66,403 in interest alone. Now, I was talking about the savings and the death benefit. So guys, this right here, $671,000 in death benefit that you have just available. So there's a life insurance policy built into this. Guys, this is amazing. So what I want to challenge you all, be like Manny and Janet. Guys, choose BYOB by Exertus. Let us show you how this can benefit you. All you have to do, just below here, you have a form. There's a little form. It's going to ask you a couple of questions. It's not much. And then just below that, you can have the ability to schedule your initial consultation call. Now, what I want to let you know, there is no requirement. There's no, obligation. Just provide us a little bit of your information. We'll start putting this together and we'll hop on a call with you. It'll take 20 to 30 minutes. We'll verify the information. We'll just kind of get to know you a little bit of what your goals are. And then from there, we can build out that case. And we can show you on paper, just like what we had for Manny and Janet. We can show you exactly what your scenario would look like. And at the end of the day, if it makes sense, awesome, it makes sense. But if it doesn't, that's fine too. But we want to show you how this generational wealth can be started and it can be built starting today. So guys, thank you for taking your time to be on this with us. And then I want to invite you again, please fill out the form below and then click on the next button and schedule your initial consultation call with one of our representatives. We would be more than happy to go over this and answer any questions that you may have. Thank you so much for being here, and we'll talk to you soon.